Oh, tax season. It's so stressful. You want to get it done before the deadline. You also want to make sure you're not making any mistakes. Either you don't get the rebate that you deserve or you end up paying more taxes. It's complicated, it has a lot of paperwork involved, and it ends up to be very stressful. That's why when you add investments to it and when you have to claim for your gains and losses related to your investment, things can get too complicated too fast. That's why in this episode, we're going through the key tax related concepts as it relates to your long-term investments so that you can glide through the tax season without any complications. Just one thing before we start. If you live in any country rather than United States, you need to make sure to do your research and understand the tax implications of your long-term investing. Everything we discuss in this video is mostly related to the tax law of the United States. With that, let's get to it. Number one, take advantage of tax sheltered and tax favored investment accounts. Let's talk about it a little more. In the United States, the government offer tax sheltered and tax favored accounts to incentivize the citizens of the United States to invest for the long term. Those accounts are things like 401ks, IRA accounts or IRAs. There are several of them. Make sure to understand which tax favored or tax sheltered accounts you're eligible to apply for and take advantage of transferring money and investing in those accounts before you move on to any normal taxable accounts. Number two, understand the difference between taxes on short-term investments and long-term investments. Generally speaking, when you invest in any financial product, be it stocks or fund or an ETF, you have to pay taxes when you sell that stock or that financial product. If the amount of money you paid to invest in that company and the amount of money you're getting when you're selling is different, you either have what is called as a capital gain or capital loss. So if you're selling within the course of first year of your investments, your taxes are higher because you are being taxed on what is called as short-term investments. Make sure as a long-term investor, wait until at least 1 year and then sell your investment if you wish to, so that you don't pay the short-term capital gain tax, but you can reduce your taxes to long-term capital gain tax, and that will optimize or minimize the amount of tax you pay. By the way, as a long-term investor, what are you doing selling your investments in less than a year? I don't even understand that. But anyways, if you do, make sure that you understand you're gonna pay higher taxes. Number three, don't trade. I know we've been talking about it and we're long-term investors, but again, let's emphasize on it. Trading means that you're getting into an investment and getting out of an investment rapidly, maybe in the course of a day, in the course of a week, in the course of a few months. Every time you sell an investment, you're gaining or losing some money, and if you're gaining some money, you are required to pay capital gain tax on top of that investment. Traders are prone to pay a lot more taxes on their investments because they're prone to sell their investments a lot more faster than a long-term investor. And by the way, they're also required to pay short-term investment tax that we talked about it in the previous point. So avoid trading altogether. That will help you pay less taxes as you go through your investments. Number four, harvest your losses. Did I scare you? Tax harvesting your losses. It's not too complicated, but if you hang out in investment forums, you'll hear about these things all the time. Let me explain it to you. We've actually talked about this in one of the earlier episodes when we were talking about when to buy and when to sell your investments. This is how it goes. When you sell an investment and you have capital gain, you have to pay taxes on it. When you sell an investment and you have some losses on it, you can claim that loss to reduce your annual income. So what happens is that in order to minimize the amount of tax that you pay, you can sell those investments together in the same year. You can balance up the amount of capital gain you have with the amount of capital losses that you can claim. That helps you to avoid paying taxes on the winning stock by claiming the losses you have in the same year. The only thing you need to be mindful of is that you can't just claim as much losses as you want. There is a maximum cap that the law allows you to do that. So when you're claiming or when you're trying to harvest your taxes or harvest your losses, make sure you understand what are that cap amount so that you don't go over the limit. Number 5, be mindful of your dividends. What are dividends if you don't know? Some companies, when you invest in them on a consistent base, they pay a portion of their earnings to the stockholders or the shareholders. Those are called dividends. The bad news about them is that if you invest in those dividend paying companies in a taxable brokerage account, those dividends are considered as normal income and you have to pay an income tax on them. So make sure to invest in dividend paying companies in some of your tax favored or tax sheltered accounts. If you use those tax sheltered or tax favored accounts to invest in dividend paying companies, you don't have to pay any income tax on your dividends. The other thing is, if you're investing in foreign companies that pay dividends, the things get a little bit more complicated. If as an investor, you're already advanced enough that you made a decision to invest in foreign companies, you need to make sure whether you have to pay for those foreign dividends in the country of the company. Most of the countries have a treaty or some sort of an agreement with the US government that you can pay for those foreign dividends through your normal way that you pay your investment taxes or your dividend taxes. But in the end, as an investor, you need to be mindful of that. Make sure if you're picking up some of those less known and less famous foreign companies, make sure to ask about the dividend tax implications of that investments from your brokerage account, or at least Google them before you pull the plug. All right, we're almost to the end. Number 6, start filing your taxes early. This should be already very obvious to you. But as we talked about at the beginning of this video, as an investor, you have to file for your taxes, and it adds an extra layer of paperwork and complications to your taxes. So make sure you start early and give yourself enough time so that if you come across things that you don't understand, you can ask around or you can Google them. I personally use some of the free tools that are available online, such as Credit Karma, to file my own taxes. I put all of my investments, I collect all my documents from my brokerage account, and I do it on my own, and it costs me nothing. Start early and you'll be gliding through your tax season without any problem. That's it, folks. Let us know what you've learned, what you like, what you dislike about this video series, and send us your questions, comments, and ideas for the next series. In a few weeks, we'll be back with the season 2 of the How to Invest video series. Make sure to subscribe so that you get notified when the season 2 is available. We'll be seeing you soon.